Well, I just want to start off by saying thanks very much to Peter and to Travis for having me today, and Peter for that lovely introduction. I'm delighted to be here, and I'm very eager to get your feedback. We were having um, an exciting, kind of engaged conversation before you all joined, so hopefully we can continue that with the larger group. So I do want to be clear at the outset that I am a tax lawyer and a tax scholar, and I am not an insurance lawyer or an insurance lawyer. But given my experience in tax practice, I'm very interested in how taxpayers manage risk, manage the kind of possibility that they could end up having a large tax bill kind of because of uncertainty in how the law applies to their circumstance. And I'm very interested in understanding how private tax risk management practices can inform the design of our tax laws and our efforts to improve tax compliance and enforcement. So I've done a good bit of work on the role of tax advisors in tax risk management, including through tax opinion practice. And I've also done work on tax risk sharing among multiple taxpayers. And those projects ultimately led me to tax insurance. So interestingly, there's relatively little scholarly literature analyzing the normative implications or the possible regulatory role of tax insurance. And among the few scholars that have analyzed these issues, the emphasis is largely, with one notable exception, on the policy problems that tax insurance can create. And in contrast, my article analyzes how understanding tax insurance might actually help us improve tax compliance. So let's say a few words about tax compliance. So tax non-compliance is a problem. There are several sources of non-compliance that contribute to what is now a $600 billion, maybe even a $1 trillion tax gap annually. That is taxes owed but not paid. So that's a lot of money. And it comes from several sources. But one part of the tax gap comes from non-compliance by sophisticated taxpayers, high income, high wealth individuals, complex partnerships, and large corporations. And that has been a serious problem. The IRS has long been outgunned and has really struggled to pursue meaningful, effective audits against these taxpayers. So as IRS Commissioner Danny Werfel said, it's critical to increase IRS compliance and enforcement efforts on key areas of compliance concern, including high income, high wealth individuals, partnerships, and corporations. Now, in good news, the Inflation Reduction Act, passed in the summer of 2022, provided additional money for the IRS, and a significant portion of that money was dedicated to enforcement with respect to these taxpayers. And that is great, and that has been showing some promising results, but there continue to be congressional efforts to reduce IRS funding. And even with the additional investment, these sophisticated taxpayers continue to pose a big enforcement challenge. So why is it so challenging to do tax enforcement with these taxpayers? Well, a big part of the reason tax enforcement is so challenging with these taxpayers is because some of the most successful tools that we have for increasing tax compliance and facilitating enforcement can't really capture the income of these sophisticated parties. So I'm talking about withholding, like when you go to work and your employer doesn't give you your whole salary, they send part of it to the government on your behalf. That's withholding. And third-party information reporting. So like when your bank at the end of the year sends you a 1099 form that reports to you how much interest you've earned in your account, they send a copy of that to the IRS. So we have third parties, employers and banks and lots of others, but those are some examples who kind of serve in a helpful way, right? So these tools, they use third-party intermediaries to get information about taxpayers' tax situations, sometimes even their tax dollars, get that stuff to the IRS. And so non-compliance, where there's withholding or information reporting, is extremely low. And you can understand that because, like, if it says on the form you earned this much interest, you know you're going to get caught if you don't report that interest. But withholding and third-party information reporting either don't apply or are insufficient and ineffective in many scenarios involving the financial affairs of high-income, high-net-worth individuals, complex partnerships, and large corporations. And really, that's often because there just isn't a well-placed third-party intermediary that can monitor and report. And so the IRS lacks information about the activities of these parties, and it makes it hard to have effective enforcement. So I think there's another third party we need to think about, another private sector intermediary that could be leveraged to assist the IRS with high income and high wealth taxpayers, complex partnerships, and large corporations. And I'm talking obviously here about tax insurers. So the idea is to capitalize on tax insurers' self-interest and add some carrots and sticks, and in doing so, effectively expand the IRS's enforcement abilities among the insurer's clients, who happen to be the same high-income, high-wealth taxpayers, complex partnerships, and large corporations that the IRS really struggles to reach. So the concept would be that insurers that commit to insuring only likely compliant positions would be effectively deputized as private sector tax enforcers. The IRS would treat insured positions, those sustained on the private audit, as likely compliant, and then the IRS could reallocate enforcement resources towards taxpayers and tax positions more likely to be non-compliant. Now, this idea is not without concerns, and we will talk about that. But I believe it's worth exploring the possibility that tax insurers could be allies rather than foes in the effort to improve tax compliance. So now that's the introduction, and to flesh this out, I want to do three things. One, I'm going to tell you a little bit about tax insurance and how it works. I'm going to argue that the tax insurance industry is a good candidate to potentially assist with compliance and enforcement, and explain how they could be used to supplement IRS enforcement efforts, and in doing so, discuss pros and cons of engaging tax insurers as private enforcers. And along the way, I'll try not to be too tax wonky, so if I am, please, when we get to Q&A, kind of push me on stuff that if I said things you don't understand. Okay, so why do we need tax insurance, right? Like, what's going on here? The issue is that many tax positions are uncertain, right? Some things are clear, but a lot of things are actually uncertain. It's uncertain about how the laws apply to specific circumstances. And tax professionals, we typically describe the degree of uncertainty with reference to the likelihood of success on the merits, assuming a position is challenged. So we'll say things like, this position will succeed. This transaction will qualify as a tax-free reorganization. Or we'll say, this position should qualify as a tax-free reorganization. It's more likely than not this transaction will qualify as a tax-free reorganization. Like, well, there's substantial authority that the transaction will qualify as a tax-free reorganization. Like, I guess, well, there's a reasonable basis to conclude that the tax transaction would qualify as a reorganization. And you see the not frivolous and frivolous down at the end there. Okay. The thing is that many positions are not will level certainty, right? And so that creates significant exposure for taxpayers if the position is successfully challenged, and taxpayers want to manage that risk. Okay, so how do you manage that risk? Well, one way to do that is through tax insurance. And the way tax insurance generally works at a high level is that a taxpayer pays a lump sum premium to an insurer. And in exchange, the insurer agrees to indemnify the taxpayer for losses if the insured position is successfully challenged by the tax authority. And that indemnity typically covers not just the additional taxes that are due, but also interest, penalties, contest costs, and a gross up, meaning if the insurance payment is taxable, then they'll cover that too, all up to the policy limit. And so the idea here is that tax insurance provides economic certainty for the taxpayer despite the tax uncertainty. It converts a contingent tax liability into a fixed cost, quantifying the worst case scenario. Okay, so this is a specialized type of transactional liability insurance like reps and warranty insurance, which you may be familiar with, but reps and warranty insurance covers unknown risks, whereas tax insurance covers specific known risks. Now, tax insurance is far from the only way taxpayers can manage tax risk. They can also get comfort about their tax treatment in other ways. So for example, they could get tax advice or a formal opinion from tax counsel, and that is a lot less expensive than tax insurance for sure. But it generally doesn't provide the economic certainty that tax insurance provides. Basically, because if your lawyer is wrong about the tax treatment, the lawyer doesn't have to reimburse you for all the taxes that you then end up having to pay. Right? That goes all to like malpractice claims, and generally the lawyers are only going to be liable for damages if they fail to meet the requisite standard of care. A taxpayer can also get comfort about their tax position by getting what's called a private letter ruling. That is, they would go to the IRS and say, hey, IRS, we're doing this transaction. Here are the facts. Will you give us a ruling that's private, like applicable only to us, that says that our transaction qualifies for this tax treatment? But number one, that takes a long time. It's usually at least 6 months in a process. And there are many, many issues on which the IRS will not rule. They won't even entertain rulings. Every year at the beginning of the year, they publish a no rule list. It's like, here's this long list of things we will not rule on, so don't even come knocking on our door. And even if there are things that they will rule on in general, they might not rule on the request that you give them. So PLRs, private letter rulings, are not available for a lot of the tax exposures that concern sophisticated taxpayers. So tax insurance can be an important alternate tool in managing tax risk because, as I said, it provides economic certainty for the taxpayer despite tax uncertainty and converts that contingent tax liability into a fixed cost, quantifying the worst case scenario. So I want to give you a little example so you can have something to hold on to. And this is just one of many. There are a huge range of tax positions that are insurable, but here's one. So we'll call this one a tax credit equity transaction. So imagine there's a developer and they want to do a low income housing project, or they want to do a renewable energy project, right? These are things that for which there are some tax incentives in the code. You can get credits if you meet certain requirements when you're building low income housing or when you're pursuing a renewable energy project. And so the developer in these circumstances usually needs to get some investors because the developer can't pay all the entire cost of the deal. But the thing is when the investors are thinking about investing, the economics of the deal depend on getting the credit, right? If there's no credit, the investors are like, the return's not going to be enough for me, I'm not going to invest. And so the economics of the deal depend on getting the credit. And uncertainty about whether the tax credit will be received can, in some circumstances, prevent investors from investing, in which case the project dies. It doesn't move forward and we don't get that low income housing or we don't get that renewable energy project. And so if the developer, the project, can insure the tax credit, that often can give enough economic certainty about the receipt of the value of the tax credit so that investors invest and the project moves forward. So I think that's a nice example of a common context in which tax insurance is used. But like I said, there are lots and lots of examples. So I'm happy to give you more if you'd like. Okay. So with that example, there are a few more things to note about tax insurance before we kind of move as part of our background. One is in terms of the terms. So the premiums are usually pretty low, 2 to 6% of the policy limit. And the policy limit per insured position is generally a minimum of $5 million, but can exceed $1.5 billion per tax issue. Okay, so the policies are commonly several $100 million. So this is for big tax exposures. This isn't for me. This isn't for you. I mean, unless you're doing some really high value things. This is for big projects. So there's some the retentions are really only for contest costs. There's some limited exclusions, claims periods based on the statute of limitations for objecting to the tax treatment. And the insurer has some rights, but they're kind of they're not kind of that overwhelming. So what happens when someone wants to get tax insurance? Well, the taxpayer generally engages a broker who helps the taxpayer compile information about the position to be insured. So they'll take the analysis prepared by the taxpayer's lawyer, and then the underwriters will evaluate the submissions, give non-binding quotes for coverage. The taxpayer selects an insurer, pays an underwriting fee, and then you go through the formal underwriting process where the insurer independently assesses the strength of the tax position. And they do this using their internal tax lawyers. This is, I tell my students, if you go work for a big firm, you do this work, do that kind of tax work for a while. Outplacement, you can go to in-house counsel, but you can also actually go to tax insurer. They've been hiring a lot of people in-house. But sometimes the tax insurers don't use their in-house people particularly for specialized issues, and then will go and hire and engage outside counsel so they can get an insight into kind of the strength of the position. Then, the parties will negotiate terms. It's a bespoke policy. It's like a one-off. It's not a form policy. And ultimately, the taxpayer will pay the premium and the insurer issues the policies. And that can all be done in as little as 15 days from engagement of the broker to the issuance of the policy. Usually takes a little longer, but it's pretty fast. Okay. So one other thing to know about tax insurance is that the tax insurance industry has really exploded since the mid 2010s. And the number of policies placed annually has increased by over 1,000%, 2015 to 2021. Now they're regularly placing in excess of $30 billion policy limits placed annually. And you might wonder why, like what has happened that has led to this massive growth. And so let me just give you a little bit of backstory here on the kind of on what's been going on. So there's been a lot of evolution in the Treasury's view of tax insurance. In 2000, the Treasury Department was very skeptical of tax insurance. They included tax insurance in draft regulations about what we call reportable transactions. Basically, these regulations identified transactions or features of transactions or positions that the Treasury thought made them suspect, things that were likely to be non-compliant or tax shelters or something sketchy. And the idea was that any position or transaction with tax insurance would be on this list, one of these reportable transactions. And so there would be extra reporting obligations with respect to the transactions. The IRS would treat these transactions as suspicious and would likely audit them. And nobody wants to have their transaction treated as a reportable transaction. It's like a death knell for your transaction, okay? Because it's like going to the IRS and being like, hey, look over here. We might have a problem over here. Don't you want to audit us? The industry was very unhappy about this. But so there was discussion over time, and ultimately in 2003, the Treasury promulgated final regulations that did not include that proposed language. So under the final regulations that came out in 2003, the mere purchase of tax insurance didn't make a transaction or position reportable. So this was good news. And there were some people who thought that the tax insurance industry would explode then, but it didn't. So what happened later? Well, in 2014, the service issued a revenue procedure that indicated that third-party tax insurance was an acceptable way to guarantee the tax contingent economics of a tax credit equity deal. Okay, the RevProc, the revenue procedure, was not about tax insurance. It was about the details of how to qualify for the credit. And there was this kind of almost throwaway line in there about kind of tax insurance. Okay, but people jumped on it. And the language suggests acceptance of tax insurance as a non-abusive tool, at least sometimes. And this language, which was reiterated in the 2020 revenue procedure, has been interpreted by many as the IRS's blessing. Now, I can't prove a causal connection between the 2014 RevProc and the explosion of the tax insurance industry starting in 2015, but the timing seems notable. And I'll tell you that a lot of the tax insurers cite this revenue procedure in their promotional materials. So there were other factors in the growth too of the tax insurance industry, including maturation of the industry, capacity for larger policies, lower premiums, streamlined processes, and increased awareness about tax insurance among tax advisors. So that's really the background about tax insurance. So you get a sense about kind of what's going on there and what's the backstory and how it works. And I think that background hopefully helps to illustrate why tax insurers might be a promising candidate to be a private sector tax enforcer. So I think that there are several advantages that tax insurers have. One is information. Insurers have a whole lot more information about the relevant position than the IRS, okay? Taxpayers voluntarily provide the information to insurers as part of seeking insurance. This includes the opinions of counsel, the analysis of counsel. They're like, look at all this stuff that we have that shows that this is a good position. Taxpayers don't voluntarily turn over that kind of information to the IRS. Like, that's the point, right? So insurers don't face the information asymmetry problem that hinders the IRS's enforcement efforts. So there's an informational advantage. What else? There's an expertise advantage. Insurers just have more expertise than the IRS. The IRS is full of really talented people, but there are only so many people who work there. And they've been hiring more people, but they don't have as much access to as much specialized expertise on every little issue. Because insurers have tax experts in-house, but they can go to outside counsel for highly specialized expertise whenever they need to. And similar capacity. The IRS is hiring, but it's still budget constrained, whereas insurers have more flexibility in expanding their capacity when needed. Because often what they'll do is they'll use the underwriting fee to pay for the outside counsel's tax advice. And so if you have more requests that come in with more underwriting fees, you hire more outside counsel, and you can kind of adjust the expertise capacity that you have with the deal flow, which just the IRS doesn't have that kind of capacity to kind of do ad hoc expansion and contraction. So what else? Clientele. Tax insurers deal with many of the taxpayers that the IRS struggles to reach, and influence. So the insurer generally interacts with the taxpayer before a position is taken, and so they can influence a taxpayer to make changes that can increase the likelihood of compliance. They can say, oh, change this thing, change that thing, right? So just like your home insurer is like, well, do you have an alarm on your house? Because if you put an alarm on your house, we'll give you a discount on your premium, right? So they can do something equivalent to that. And tax insurers can decline to insure a position. And some of the folks that I've talked to said that sometimes up to 50% of the requests for tax insurance get declined. But if your tax insurance request is declined, that might dissuade a taxpayer from taking the position. So one other thing that makes tax insurers, I think, promising private sector enforcers is that they're relatively independent of the taxpayer whose positions they insure, right? Tax insurers are highly self-interested. They will lose real money if they're wrong, right? So they're unlikely to sacrifice their own interests to help a taxpayer, right? Now, there are some concerns because, of course, the insurers are being paid by the taxpayers who are seeking the insurance, but the insurers are likely to be more independent than tax counsel for a taxpayer, right? Tax counsel, very valuable, but they're not as reliable gatekeepers because kind of the counsel owe a duty to their client, and they don't bear the kind of downside financial risk that insurers do if the position on which they advise is successfully challenged, right? So tax insurers, they don't owe a duty to the client, they owe a duty to themselves. They're caring about their own money. So I think that they're less likely to unwarrantedly acquiesce to a taxpayer's preferences. Okay, so maybe these companies are good candidates to help with compliance and enforcement. Now, but it only works, right? It only works if the insurers insure strong positions and decline to insure weak positions. And the insurers claim that that is exactly what they do. They say that should level certainty, right, positions with kind of should level certainty, likelihood of success on the merits, is their sweet spot. And also the more likely than not positions. So the ones that are over here a little bit kind of below should in terms of level of certainty, but more than 50% chance of success on the merits. Okay. But the real question is, are insurers insuring weaker positions? Are they? They say they're not. One quote from one person I talked to was like, why would we kill the golden goose? Making them a lot of money. But it's possible that they're insuring weaker positions, right? Because they could effectively be issuing what we would think of as detection insurance, right? We're going to insure your position based on the likelihood of that it will be audited, the likelihood that it will be found upon an audit. But detection insurance could be dangerous, right? Because that kind of could reduce rather than increase compliance, right? Because if they're issuing insurance for very weak positions, ones that are likely not compliant, right, then the insurance could enable, empower, and even encourage taxpayers to take very aggressive positions that they would not otherwise take in the absence of insurance. And that would make the enforcement challenge for the IRS worse, because more taxpayers might be inclined to take a greater number of increasingly aggressive positions. So we really don't want insurers insuring weak positions, positions that are not likely to be compliant with the law. So it hurts our compliance efforts if tax insurers are issuing detection insurance, but it helps if tax insurers are issuing insurance to strong positions, positions that are at least more likely than not on the merits to be to be sustained if challenged. So we can think a little bit about the incentives for insurers, right? What are the incentives for insurers, right? Insurers have an economic incentive to insure if the benefit to them, premium plus any indirect benefits, exceeds the product of the probability of loss and the amount of loss, right? Because this calculus, insurers' incentives could be manipulable, right? We could increase benefits with additional carrots, increase the magnitude of loss with sticks. Those little guys there, those are sticks. Some people have thought they are like asparagus or something, but they are sticks. I intend them to be sticks, so we will all accept that they are sticks. And you can also increase the probability of loss. Okay, so we can tweak those components to try to align insurers' ex ante interest, that is, when deciding whether to insure a position, with the IRS interest in compliance. So that's the idea. Okay, so to leverage insurers as private enforcers, I think first we need to require mandatory disclosure of tax insurance. That increases the probability of detection. Disclosure, not to say that they're all bad, but disclosure just to provide some information, and the insurers would provide basic information about each policy, the issue insured, the policy cap, the policy limit, the premium. And then have a regime where in which enforcement enhancing insurers self-identify by opting into this qualified insurer regime. We actually have a similar regime for certain foreign banks that are what we call qualified intermediaries that opt into a system. So, but here the idea would be the insurer would opt in and commit to a conservative insurance practices, ensuring only positions that are likely to succeed on the merits if challenged, and they'd agree to a cooperative approach to audits. The IRS would audit a sampling of the insured positions, and if they're sustained, or even if they're potentially challenged, but the position was a strong position in the first place, the insurer could become a qualified insurer. Insurers that don't opt in are non-qualified insurers, but are still subject to the disclosure requirements. And then the existence of insurance from a non-qualified insurer would be a big red flag. And the IRS would audit those at a much higher rate. That would be a stick to encourage participation in the qualified insurer regime. The qualified insurer regime would yield benefits. Here are some more carrots. Benefits for the positions insured by the qualified insurers. Those positions would be treated as pre-screened and likely compliant, meaning and would be benefit from a lower likelihood of audit, perhaps an expedited ruling process if the for the insured position if the taxpayer wants a ruling, an expedited audit process if there ultimately is an audit. And there are benefits for the insurers themselves as well. They can confer those benefits by insuring a position, right? And they can market, right? The IRS would publish a list of qualified insurers, encourage taxpayers who are seeking insurance to use the qualified insurers. The qualified insurers can advertise their qualified insurer status. We might need some tax credits to incentivize insurers or taxpayers to participate as a regime like this would get going. But we'd also add some sticks to incentivize qualified insurers to live up to their commitment, right? We don't want people to I've qualified and now I'm going to do terrible things, right? So we want to add some sticks to incentivize qualified insurers to live up to their commitment to insure only strong positions. IRS would need to continue to audit a sampling. And if the position is not sustained and kind of was weak position in the first place, there could be strict liability penalties, maybe removal from the list of qualified insurers, plus an increased audits by the IRS of other positions of other taxpayers insured by the same insurer, right? That is, if the insurer insured a bad position here, we think the insurer might be insuring bad positions elsewhere, so let's go take a look. So at least in theory, this could create a virtuous compliance spiral. That is, insurers are incentivized to become qualified insurers, taxpayers are incentivized to get tax insurance from qualified insurers. That further incentivizes insurers to become qualified insurers. And because a taxpayer's audit risk increases, if other positions of other taxpayers insured by the taxpayer's qualified insurer are successfully challenged, the taxpayers would be incentivized to get tax insurance from the most conservative qualified insurer that would insure them at a price they were willing to pay, which could create market demand for conservatism among qualified insurers, thereby increasing the IRS's confidence that the insured positions are likely compliant. Ultimately, the idea is to get insurers to and sophisticated taxpayers to self-sort, into this group is likely compliant, and this group hasn't done the things that indicate that they're likely compliant, and the IRS can target more resources to the latter group. Okay, theory sounds good, maybe, but there's a reality. We need to have a reality check, right? Can it work? Well, for it to work, it would really be important to kind of curtail gaming, right? Insurers would have to be able to really successfully separate likely compliant tax positions from not. But they're pretty good experts and they hire good experts, so I'm pretty comfortable with that. The IRS would also have to be able to separate good private sector enforcers, that is, insurers that insure only strong positions, from other insurers. And that could be a challenge. And there would have to be IRS kind of a strategic ongoing auditing to suss out the fakers, right? The IRS needs to be able to suss out the fakers. There could also be other gaming, like a taxpayer might get tax insurance on a strong position to hide other weak positions. So that's a risk. Now, maybe you could have some sort of extra penalties if you have tax insurance here, but then you get audited and lose over there. We also have some questions about, do the benefits outweigh the costs, right? What are the benefits here? Well, the benefits could be a reduction in IRS enforcement costs for these taxpayers who are getting tax insurance, allowing a reallocation of those funds elsewhere. And more matters ultimately are being audited by a combination of the tax insurers who are auditing a bunch of positions kind of through the insurance process and the positions that are audited by the IRS. Together, that means we're auditing a whole lot more positions than we're auditing today. Now, the magnitude of the benefit depends on the number of positions insured. It depends on the reliability of the audits. So there's a delicate balance here, right? Kind of to maximize the benefits, we want to ensure that we calibrate the carrots and sticks kind of correctly. Because if we don't, this idea could just cause the whole insurance industry, tax insurance industry to collapse, right? So we want it to be aggressive, enough sticks to deter overly aggressive insurers, but enough carrots to keep insurers of likely compliant positions in business. But there are costs to this, even if there are some real benefits. There are costs to create the regime, costs to implement the regime, and those costs could use up all the savings, right? It could use up all the savings, and that's entirely possible. Although I do think that this is a more cost-effective regime if there are fewer qualified insurers, that's a more centralized process. So there are also other policy concerns, right? There's concerns about fairness and perception of fairness, right? Are rich companies buying their way out of kind of the audit risk? Like, is that fair? There are concerns that, we have a private actor making private profits from performing a public function. How do we feel about that? There's also a possibility that kind of the lower audit rates of insured positions could mean that qualified insurers kind of have more power over the interpretation of the tax laws, kind of leading to some policy drift. There are also concerns about whether the IRS has the authority to implement this kind of thing, which they certainly couldn't do by themselves. They could do pieces of it by themselves, but they'd need Congress to do a lot of it. So there are a lot of challenges for this idea. But given the massive growth of the tax insurance industry and the continuing compliance problem among the taxpayers served by the industry, I think it's worth considering whether we can harness these private sector tax insurers for the public good. Okay, this article offers one way we might do so, and this isn't necessarily the right answer. There could be certainly other ways, but I hope that at the very least, this article spurs thinking about the possibility that tax insurers could be an ally of the IRS in its effort to increase compliance and enforcement among sophisticated taxpayers. So I'm just about at 40 minutes, so I'm going to stop there, and I look forward to discussing this with all of you. Thank you so much for listening.
Wonderful. Thank you so much. So you can raise your hand. Okay, and Ronan Avraham is not only the alphabetically first. Oh, no, he's not. But anyway, Ronan, you got the first question, and then Neil, and then Aisha. Ronan, go ahead. Ronan, are you there? All right. How about Neil then?
Yeah, thank you. Great paper. I really enjoyed reading it. I'll admit it's the first I've ever heard of tax insurance. But you answered a lot of my questions about like regulating the insurance companies, or at least putting a threshold that they would have to leap over before they get there. But how do you do that in light of the fact that the IRS just can't regulate insurance? It's a sort of a state actor feature of regulation, and the IRS they're not even in the insurance business. So how would they like have financial bearings enough, like enough capitalization to pay for these things? Or do you purely put that on the purchaser, that if you go with a qualified insurer, that doesn't mean that they're able to pay your claim if we disagree with you? It's just that they're qualified from a tax analysis perspective.
Great. Thank you so much for that question. So a couple things. One is there are costs here for the IRS, and this would require an allocation of some of the budgetary resources towards getting the system set up. But the hope is that then in the long run, it would lead to cost savings because there would be higher compliance at lower enforcement costs in the future. But there is definitely an upfront cost here. And you're right also that the IRS doesn't have any kind of power to regulate insurance companies, but they do have the power to require disclosure of certain types of information, right? They can put the tax insurance back on the reportable transaction list. That's something the IRS can do by itself. And then the idea could be that, if insurers opt in to a program, they say, we voluntarily submit ourselves to this to the IRS oversight in this particular way, then they have given power to the IRS, as opposed to the IRS saying, we have this power. The IRS could say, hey, here's what we'd like to do. Would you like to participate? And so if the insurers choose to participate, then the IRS, I don't think, although correct me if I'm wrong, doesn't need to have specific power to regulate the insurance companies.
Well, can I ask a follow-up to that? Because it seems to me that the paper, is very careful and thorough and hedges appropriately, like, these things have to be true and all that. So that's great. But you don't really talk about insurance regulation. I mean, all the rest of insurance is heavily regulated in all kinds of dimensions. You have to have enough capital, as Neil just said, but also your underwriting practices and your claims handling processes and your pricing. It's like all that is governed by somebody. It's not just like you set up a business and say, hey, I'm going to offer insurance, and then you're off to the races. And your paper doesn't really talk about what that background regulation stuff is. That's like a floor for having a market exist in the first place. There's insolvency, and there's just like a million other things that are part of the institution of insurance that I guess you're just assuming it's going to be regulated in the same way that the rest of insurance is, but there's like McCarran-Ferguson issues and who's going to do it and blah, blah, blah. So anyway, you want to comment further on that?
Sure. So I guess what I'd say is this industry exists now, right? So whatever state kind of infrastructure that exists to regulate the insurance industry applies now to these insurers who are providing tax insurance. And so my expectation was that whatever that kind of regime is would continue to operate and continue to operate kind of in accordance with kind of state law as it has been operating. So the idea was just kind of an overlay of kind of an optional opportunity for insurers who chose to kind of engage with the IRS in this way. Like I said at the top, I am not an insurance expert, but my understanding was that the state infrastructure it already exists and could continue to exist. And I don't think that kind of overlaying this optional contractual arrangement kind of would necessarily change that.
Okay, there's lots of people who know more about that than I do, but I'd be a little bit skeptical about that. So the list of people is Ronan Avraham, Aisha Stovall, Michael Abramowitz, and Larry Reback. And if you still want to raise your hand, please feel free to do so. Ronan, you're on.
Hi. First of all, I really enjoyed the paper. Obviously, the idea of private regulation is an old one, and I myself actually have written about that, and it never occurred to me that it could be in the context of tax insurance. So I really enjoyed your talk. I have a kind of a small question. So you really seem to think about a lot of things that need to be handled. Well, and you mentioned in passing that there should be some disclosure about the premium and about the cap and one thing that strikes me is that this could provide important information to the IRS about the risk in the eyes of the insurer about the position that the taxpayer takes. And that kind of raises an interesting strategic gaming here, because maybe to signal that the risk is actually not that big, they'll drive the prices, that can drive the prices that the insurers charge down. So I don't know if you thought about all that.
Yeah, so that is an incredibly important issue, and I spent a good bit of time thinking about that, because trying to think about all the sneaky ways that you could change the terms to try to signal it's strong, that a position is stronger than it otherwise would be, and I try to get into some of that and kind of in the paper, because you're right, like, well, what if we offer kind of we have a much lower premium, but we've got some special terms that kind of say all of these things are excluded and not covered, and then but if you don't know about all the detailed exclusions, then the price looks like it suggests that the risk is really low. Yeah, so there's a lot of gaming opportunity there, which is Absolutely concerning. And I guess what I was trying to do, and this would obviously, if we were to even think about moving forward, would need refinement, is to think about like, well, how can we identify the terms of the agreement that are that it would give the IRS enough information to make an appropriate inference. One thing I raised in here was the possibility that you could even have some sort of kind of a standardized form that has, you know, kind of here are the basic terms, and maybe you've got an appendix that's got kind of some things that enable it to be kind of tailored to the circumstance, but then you'd have to share the schedule with the IRS to kind of show those things. I don't know if that would kind of that would fly. It might not, because this is an area where people really want bespoke coverage. But that is, yeah, it is. There's potentially a lot of games to be played there.
Yeah, thank you. Very interesting. Thanks.
Thank you.
Great. So Aisha, you're up next.
Hi, and thank you so much for coming. I thought your presentation was actually very good, and I agree, they look like sticks. They didn't look like asparagus to me at all. So
Thank you.
I think it was a great picture. But that aside, I was wondering, so I'm very much new to the world of insurance, but in captive insurance, we learned that it's pretty much ruled by like case law and the revenue rulings from the IRS. And because the IRS is a government entity, there's the expectation of, you know, transparency and fairness. And those things don't necessarily go hand in hand with private insurance. And so I'm wondering how those differences are reconciled with private actors basically stepping in and usurping a government entity.
Yeah, so I think the use of the word usurp is a really interesting word there, because there are a lot of ways to think about what the insurers would be doing here, right? So one way would be to think about like they're being delegated some responsibility, but a delegation, of course, can bleed into a usurpation, um, right? And you know, delegation of some responsibility to assist with the government, that's good, but allowing too much government kind of power to be kind of effectively privatized can be a real problem, and there's a line that we need to figure out how to draw here. I trying to figure out a way to make it narrow enough what the insurers would be doing here that you wouldn't have too much concern about that. But that's a real concern, right? That we've got a private actor who's kind of overstepping and serving in a public function, making money for themselves, doing this public function, and maybe doing it in a way that the government wouldn't want it done. And so it does require having significant limitations on what the role is of the insurer. But it's something to be very careful about for sure.
Okay, thanks. So I have still on the queue Michael Abramowitz, Larry Reback, and Mark Myerson. Michael, you're up next, and nice to see you again.
There we go. Trouble unmuting. Can you hear me? Okay, good. So this is terrific, and thank you so much for this presentation. Thank you for the site as well. I think I'm the author of the one paper that's in the
You
ballpark
are.
that you
I'm very
referred to.
excited to meet you.
And so I was super excited to see the note about this paper and to read it. And there were a lot of things in this where I thought, oh, I wish I had included this in my paper. I love the institutional detail, and I love this sort of, I think, idea that we might get a kind of separating equilibrium where maybe the good types buy the insurance and the bad types don't, and that helps the IRS. So I think all of that is great. So I did want to focus on maybe one small area of potential disagreement between us, and I wasn't sure I understood your position on this. So my thought was that it would make sense for this to have the penalty be equal to the inverse of the probability of detection. And that builds to some extent, I think, on what you're saying with regard to your concerns about detection insurance. We don't want to allow people to sort of to promote tax avoidance because they're being insured against that. And one reason I think that's a big problem is that I think, at least in the existing tax system, penalties might be kind of set too, from a deterrence perspective, too low, because we're worried about fairness concerns. We're worried about, oh, well, if it's just sort of random whether you're audited and then you get totally hammered when you're audited, we don't want the penalties to be too high. So then we set them a lot lower, and therefore, kind of systematically, probably in expected value terms, you're generally better off. Certainly for individual taxpayers, maybe it's different for some of these $100 million transactions, I don't know. But for individual taxpayers, you're probably better off actually, taking pretty aggressive positions on lots of issues. And so to me, the idea of the inverse probability of detection would kind of force you to internalize the expected penalties. So why not just say inverse probability of detection, we'll calculate your what your tax liability should have been. If you overpaid, you get a refund multiplied by that. There was a little something in the footnotes about that, but I wasn't sure I understood your disagreement on that point.
Yeah, so thank you so much for your comments. And like I said, I'm very excited to meet you. I loved your paper, and I was so excited to see someone else writing in the area. And so I delighted to get a question from you. So I think, I largely punted on the size of a penalty, right? And I will just cop to that. And I think I had some reservations, in part because I wanted there to be penalties in kind of not just on the taxpayer, but potentially also on the insurer. And so I'm not exactly sure how to calibrate that. But I do think that, kind of as a general matter, trying to set the penalties at kind of based on the inverse probability of detection is kind of a very obviously, kind of, there's a lot of literature on that, kind of makes a lot of sense. Because I was talking about both the taxpayer and the insurer and not knowing how to kind of divvy that up, I just punted on it.
All right. So Larry, you're up next, and then we have Mark, if we have time.
Yeah,
Maybe not.
thank you. I definitely really appreciated the paper. I actually work for one of the companies on your slide, although I don't do the tax insurance side of things. But a couple questions. One, in your research, speaking with insurers, did you get any feedback of whether they'd ever want to be part of this quasi-governmental enforcement mechanism? And two, the conflicts of interest just seem all over the place. And if I'm an insured, I don't know if I want to have a mandatory disclosure. And the fact that you pointed out that the lack of disclosure was responsible for the explosion of the industry, maybe this will go back to the old days in the 90s where there wasn't much insurance.
Great. So nobody really wanted to talk to me about the details of my idea. I got plenty of people who were like, I'm happy to tell you about the industry and how we work and what we're doing, but so I don't really have a good sense in response to your first question. In response to your second question about mandatory disclosure, I guess, by all accounts, the tax insurance industry like freaked out when the regs were proposed in 2000 that said it would be mandatorily disclosed, and basically it was like, this is the end of our business, you're putting us out of business, this is the most terrible thing that's happened, you think we're terrible, we're not terrible, here's all the reasons that we're good, don't paint us with your scarlet A. And I think it wasn't actually the move to not having mandatory disclosure that led to the explosion. That's what we thought. Some people thought in 2003 when it was like, okay, we're not going to have this to be require this to be have mandatory disclosure. There were some that people thought that like, oh, now it's going to explode, but it didn't. It didn't explode at that point in time. It didn't explode till a little bit more than a decade later when the IRS came out and sort of said, hey, we see this in a situation and we think it's okay. And people are like, oh, it's not, they're not just, IRS is not just neutral to it, but they're kind of positive toward it. And I do think that, like, a move toward mandatory disclosure, back toward the idea of mandatory disclosure could set off some alarm bells, and, there could be some freaking out again. but I think part of the idea would be mandatory disclosure doesn't necessarily put you on the list of being like of having a red flag, right? It could put you on a list of good people, right? So if it's because if mandatory disclosure is just bad, no one wants that. If mandatory disclosure could be good, then maybe it wouldn't be quite so problematic if people can figure out how they can get on the good list as opposed to the bad list.
Great. Mark
you.
Meyerson, you're up, and you
Hi.
got the last one, I think.
And I'll be quick. So I first this thought formulated before with the discussion of penalties, and you'll hear that in a second. So I wanted to know if you had any insight into the loss ratios of the insurance companies that write this line of business. That is, are they profitable? Which then led me to the other end of that telescope, thinking about your approved insurers, that is an unsellable product because the price of that doesn't make sense, because you're only, as an insurance company, issuing that coverage in the certification when you're certain that you're not going to pay. And from the taxpayer's perspective, there's no advantage to buying the insurance because they take the favorable tax treatment, and they themselves are certain, if the insurance company is willing to underwrite it, why do I need the insurance? So that's just sort of flipping the loss ratio and the pricing around.
Yeah, so my understanding thus far is that there haven't been a lot of claims. That there have been a lot of claims on reps and warranty insurance related to tax, but really not a lot of claims on tax insurance. Part of this is hard though, because we're talking about only not quite a decade of a lot of activity, and the statute of limitations can be 6 years, right? And so there's a lot of, I think, still some uncertainty about what the ultimate economics of this industry will be. I think that there's optimism, but also there's a lack of information, and it's possible that in the next few years, some of the pricing and the insurance practices might get materially adjusted if there are more claims than are expected. As to kind of your second point, I think is a good one. So I think, when we look at that kind of a spectrum of kind of a certainty, kind of likelihood of success on the merits, the people who have positions that are kind of will level positions, they don't get insurance now. They don't get insurance now because they don't need insurance, because they feel like the position is strong enough. They're perfectly happy to go on an opinion of counsel. And so we're really talking about the positions that are likely to succeed but aren't quite as strong as the wills, right? So the shoulds and the more likely than nots. And it's those ones that I think want the tax insurance coverage to manage their economic risk. And you're certainly right that my regime would constrain the insurers, right? And they might be less willing to insure even some of those positions, right? And so are we kind of making the target so small that there's effectively no business left? And the answer is that's a risk, right? But I think that the idea is an insurer wouldn't necessarily get kind of kicked off the qualified insurer list, for example, for insuring one position that was ultimately successfully challenged. The inquiry would go back to the question of what was kind of ex ante, what was the likelihood of kind of success when you're evaluating the position in the first place? And if it was more likely than not position that ultimately got successfully challenged, then that wouldn't get them kicked off because their ex ante choice was a good one. And that's a little weird, but we do this in other circumstances for tax purposes, where there are penalties, for example, that apply kind of that you can get out of penalties in a certain situation if there was, at the time you took the position, there was substantial authority for the position. It could be that you still lost. But if you go back and you say, what was the ex ante view of the position? Did it have enough confidence? Then you still can avoid the penalty. So we would take a similar approach here. So it's less that, oh no, something, the position was successfully challenged, and even though you thought it was an 80% chance of success on the merits, you're still going to get dinged. But here, so the idea would be to preserve the possibility, not require perfection in that kind of on an ex post basis from the insurers. I don't know if that helps, and I think that may give more space to keep a market that could be robust enough to support an ongoing business and industry.
Okay, well, the time has flown. It's now after 5, which is our usual ending time. So please join me in thanking Professor Field for a fascinating talk and responsive answers to the questions. Thank you very much.
Thank you all so much. I really appreciate your being here and your engagement with this a tax project. So thanks
Awesome.
again.